You do not need thousands of dollars to start investing. You do not need a financial advisor. You do not need to understand the stock market. You just need $100 in 20 minutes. That's it. By the end of this video, you will know exactly where to put your first $100 and how to make it grow. Even if you have zero experience and have no idea where to start. This video is for anyone who has been putting off investing because it feels complicated, risky, or like something only wealthy people do. It is not. Investing is the single most powerful thing you can do with your money in your 20s and 30s. And today, we are going to make it simple. Let's get into it. Why most people never start investing. Here is the truth. Most people never start investing, not because they don't have money, but because they are scared. Scared of losing money. Scared of making the wrong choice. Scared of not understanding it well enough. So they wait. They tell themselves they will start when they have more money, when they feel more ready, when they understand it better. But that day never comes. And every year they wait costs them, not a little, a lot. Here is a real number. If you invest $100 a month starting at age 25, by the time you are 60, you could have over $350,000. If you wait until you are 35 to start that same $100 a month, you end up with less than $150,000. Same money, same effort. A 10-year delay costs you $200,000. That is not a typo. The only difference is when you started. Fear is expensive, and the best way to beat fear is with information. So let's make this simple. What investing actually is. Let's forget everything complicated for a second. Investing is simply this. You give your money a job. Right now, if your money is sitting in a regular bank account, it is basically doing nothing, earning maybe 0.01% interest, barely keeping up with inflation. Your money is sitting on the couch doing absolutely nothing. When you invest, you put your money to work. You buy a small piece of a company or a collection of companies. And as those companies grow and make money, your money grows too. Think of it like owning a tiny slice of Apple, Google, Amazon, and hundreds of other companies all at once. You don't run the companies, you don't go to meetings, you just own a piece of them. And when they do well, you do well. Over time, and this is the key, the stock market has historically gone up. Not every single year. Some years it drops. But over 10, 20, 30 years, it consistently grows. The average return of the U.S. stock market over the last 100 years is about 10% per year. Put your money in a savings account. You get 0.5%. Put it in the market. Historically, you get around 10%. That gap is the difference between being financially stuck and building real wealth. Where to put your $100? Index funds. Now the most important question, where exactly do you put your money? Not in individual stocks, not in crypto, not in anything complicated. For a beginner with $100, the answer is simple, an index fund. Here is what an index fund is. Instead of buying one company's stock and hoping that company does well, an index fund buys a tiny piece of hundreds or thousands of companies all at once. So if one company has a bad year, it barely affects you because you own hundreds of others. It is the most boring, most reliable, most beginner-friendly way to invest. And it is exactly what Warren Buffett, one of the greatest investors of all time, recommends for everyday people. The most popular index fund to start with tracks something called the S&P 500. That is just the 500 largest companies in America. Apple, Microsoft, Amazon, Johnson & Johnson, and hundreds more, all in one fund. When you buy into an S&P 500 index fund, you own a tiny piece of all of them. When America's biggest companies grow, and over time they have always grown, your money grows. Where do you actually buy one? Two platforms are the best for beginners. Fidelity, fidelity.com. Zero account minimums. No fees to open. You can start with literally $1. They have their own index funds with zero expense ratio, meaning they charge you nothing to hold your money. Vanguard, Vanguard.com, the company that invented index fund investing, trusted by millions. Slightly higher minimums on some funds, but still very accessible for beginners. Both are safe. Both are free to start. Both have been around for decades. Pick one, it does not matter which. What matters is that you start.
How to open your first account, step by step. Let's walk through exactly how to do this. We'll use Fidelity as the example because it has no minimums and is the most beginner-friendly. Step 1. Go to Fidelity.com and click Open an Account. Step 2. Choose a Roth IRA if you are employed and under 50. A Roth IRA is a retirement account where your money grows completely tax-free. You put in money you have already paid tax on, and you never pay tax on the gains, ever. It is one of the best financial tools available to regular people. If you are not sure about a Roth IRA yet, just open a regular brokerage account. You can always upgrade later. Step 3. Fill in your basic information. Name, address, social security number. Takes about 10 minutes. Step 4. Link your bank account. Fidelity will ask you to connect your checking account so you can transfer money in. Step 5. Transfer your $100. Once your account is open, transfer $100 from your bank into Fidelity. Step 6. Search for an index fund. Type FXAIX in the search bar. That is Fidelity's S&P 500 index fund. Zero fees, one of the most popular funds in the world. Step 7. Buy it. Click Buy, enter $100, confirm. You are now an investor. That is it. The whole thing takes less than 20 minutes. You are now a part owner of 500 of the biggest companies in America. What to do after your first $100? This is the part most videos skip, and it is the most important part. Your $100 is a great start, but the real power comes from what you do next. Automate it. Go back into Fidelity and set up an automatic investment. Even $25 a week or $50 a month, whatever you can afford. Set it up so it happens automatically on payday, before you even see the money in your account. This does two things. First, it removes the decision. You do not have to remember to invest. You do not have to feel motivated. It just happens. Second, it takes advantage of something called dollar cost averaging. You buy when the market is high and when it is low. Over time, this smooths out the risk and builds your portfolio steadily. Now let's talk about the math of consistency. $100 one time, worth maybe $700 in 20 years at 10% growth. $100 every month for 20 years, worth over $75,000. The difference is not $100 versus a lot of money. The difference is doing it once versus doing it consistently. Consistency is the entire game. Check your account once a month. Do not check it every day. The daily swings will stress you out and tempt you to sell. Zoom out. Think in years, not days. The market will go up and down. Stay in. That is how wealth is built. So let's recap. Investing is not for rich people. It is for anyone willing to start. Pick a platform, Fidelity or Vanguard. Open an account. Put in $100. Buy an S&P 500 index fund. Automate it. Then leave it alone. That is it. You now know more about investing than most people ever will. If this video helped you, subscribe to Money Made Simple, because every week we break down money topics just like this in plain, simple English. No jargon, no complexity. And if you want to know exactly how to build a budget that actually works, using the 50-30-20 rule, that is our next video. See you there.